Greetings. Welcome to our e-learning module on policies and procedures for organizational growth. In this session, we will delve into the importance of finance policies and procedures for nonprofits and how to document the right ones for your organization's needs. This training is one of 6 modules in a series developed in relation to the PACE Self-Assessment Questionnaire. Each module is designed to enhance your understanding of fiscal management and its importance in nonprofit organizations. Be sure to explore these resources to further your knowledge. To ensure a well-governed and efficient organization, it is crucial to implement 8 essential policies: personnel, safety, technology, privacy, confidentiality, whistleblower, document and records retention, and finance. These policies promote a fair and safe work environment, protect sensitive information, encourage ethical behavior, ensure legal compliance, and support sound financial management. By adhering to these guidelines, organizations can foster trust, transparency, and long-term success. Understanding the foundational elements of organizational success begins with 4 key terms. A policy is a formal statement that outlines the principles and rules guiding decisions and actions within an organization. A process refers to a series of steps or actions taken to achieve a specific outcome or goal. A procedure is a detailed step-by-step set of instructions on how to carry out a particular task or activity. Finally, integrity of internal controls ensures that all processes and procedures are reliable, secure, and compliant with regulations, maintaining ethical standards and preventing fraud. Together, these concepts create a framework for effective and principled operations. GAAP, or Generally Accepted Accounting Principles, were created as a central response to the stock market crash in 1929. Its primary aim is to standardize accounting practices and ensure honesty and integrity across financial reporting. For nonprofit organizations, adhering to GAAP is not just a requirement, but a critical practice to maintain a sterling reputation amongst donors, grant makers, governments, and other stakeholders. By following GAAP, organizations demonstrate transparency and reliability, fostering trust and confidence in their financial stewardship. GAAP is founded on 10 principles that ensure consistency and transparency in financial reporting. These principles are: regularity, the adherence to GAAP rules and regulations; consistency, the consistent application of accounting methods over time; sincerity, reflecting an accurate and impartial depiction of the company's financial situation; permanence of methods, the consistent use of accounting methods to allow comparison over periods; non-compensation, the full disclosure of all financial information without offsetting debts against assets; prudence, presenting a cautious picture of the company's financials, avoiding overestimation of revenue or assets; continuity, valuing assets based on the assumption that the business will continue operating; periodicity, the reporting of financial performance in standard accounting periods; materiality, the full disclosure of all material and significant financial information; and utmost good faith, the honest and complete disclosure of financial information. Understanding and applying these principles ensures that financial statements are reliable, comparable, and transparent. Having established a strong foundation with the 10 key principles of GAAP, it's essential to understand how these principles translate into effective financial management practices. Next, we'll explore the 3 types of control activities that organizations use to ensure compliance and maintain financial integrity. Preventive controls aim to prevent fraud initially by distributing responsibilities and implementing physical security measures. Detective controls are used to identify fraud despite preventive measures through reconciliations, reporting, and audits. Corrective controls are implemented post-fraud to rectify issues and prevent recurrence through disciplinary action, software updates, and new policies. To develop robust processes and procedures, follow these 6 essential steps. First, identify the process that needs to be developed. Next, determine the roles involved and assign specific responsibilities. Implement access controls to ensure security and proper usage. Then, monitor and review the process regularly to ensure it remains effective. Finally, continuously improve the process based on feedback and changing needs. Separation of duties is vital in ensuring accountability and minimizing errors in accounting. This principle dictates that no single individual should handle all functions within an accounting cycle, reducing the risk of errors or intentional concealment. Having multiple individuals involved provides checks and balances, enhancing accuracy and transparency. In a 2-person team, effective separation of fiscal duties can be achieved by clearly dividing responsibilities to ensure checks and balances. For instance, one person can handle tasks such as processing payments and recording transactions, while the other reviews and reconciles the accounts. Additionally, one team member can be responsible for managing accounts payable, ensuring bills are paid, while the other oversees accounts receivable, tracking income payments. This division not only prevents errors and fraud, but also ensures that each financial activity is independently verified, promoting transparency and accuracy in financial management. To deepen our comprehension of the distinction between policy and procedure, we'll now delve into 2 examples of each. This exploration will provide clarity on how policies and procedures operate within organizational frameworks. These are policies because they establish overarching rules or principles guiding specific actions or behaviors within an organization. By directing all mail to a central address, ensuring the prompt deposit of endorsed checks, and verifying deposits against authenticated slips, these policies bolster accountability, security, and accuracy in our financial operations. Quarterly financial reviews, accrual-based accounting, and electronic transfer verification further reinforce transparency and integrity. Through adherence to these policies, we promote efficient, accurate, and trustworthy financial management practices, safeguarding our organization's resources and reputation. These established procedures are vital components of our financial operations, designed to ensure smooth functioning, transparency, and safeguarding of our financial assets. Unlike policies, which outline overarching principles and guidelines, these procedures delineate specific steps and actions to be taken in the execution of those policies. For instance, designating a person to open mail and separate checks, making copies for documentation, endorsing checks for deposit, and promptly depositing funds are all procedural steps aimed at translating policy into action. These procedures not only streamline our financial processes, but also provide a clear roadmap for consistent, efficient, and secure handling of our finances. By adhering to these principles, we uphold the integrity of our financial operations while minimizing risk and maintaining accountability. In the second example, we will delve into distinguishing the difference between policy and procedures related to expense reimbursements. As previously stated, policies establish overarching principles governing specific actions or behaviors. In this context, they delineate the organization's stance on reimbursing employee expenses incurred in the course of their duties. The policy ensures fairness and consistency by stipulating that eligible expenses will be fully reimbursed with the requirement of receipts for cash expenditures. it outlines qualifying expenses, including travel, conference fees, accommodations, office supplies, software, and professional fees, but emphasizes that the list is not exhaustive. Additionally, the policy mandates obtaining approval from supervisors before incurring work-related expenses, ensuring adherence to budgetary constraints and alignment with organizational objectives. Overall, these policies provide a framework for equitable treatment of employees and responsible financial management within the organization. These outlined procedures govern the specifics of reimbursing employee expenses for out-of-town travel, distinguishing them as operational guidelines rather than overarching policies within the organization. The procedures establish the methodology for reimbursement, utilizing federal and state mandated per diem rates for lodging, meals, and incidentals, as well as the current IRS allowed rates for mileage. They delineate the requirements for submitting receipts, specifying exceptions for expenses covered under per diem and for cash expenditures below a certain threshold. Moreover, the procedures dictate the process for submitting travel reimbursements via web portal and mandate approval by designated personnel, ensuring consistency and accountability in expense management. By requiring receipts for all cash expenses, the procedures reinforce transparency and accuracy in financial transactions. In essence, these procedures provide a structured framework for implementing the broader reimbursement policy and ensure adherence to regulatory requirements and organizational standards. To effectively manage policies, organizations should adopt 6 fundamental principles. Firstly, centralized systems enable streamlined access to policies, ensuring consistency and enhancing control. Secondly, developing a governance framework establishes clear guidelines for policy creation, enforcement, and review, fostering accountability and compliance. Conducting regular policy audits allows organizations to assess effectiveness and alignment with organizational goals, identifying areas for improvement. Implementing automation simplifies policy distribution and tracking, reducing manual effort and the risk of non-compliance. Providing comprehensive training empowers employees to understand and apply policies effectively, nurturing a culture of accountability. Finally, regular review and updates ensure policies remain current, relevant, and aligned with regulatory requirements, enhancing adaptability and effectiveness. By adhering to these principles, organizations establish a robust foundation for policy management, promoting transparency, efficiency, and compliance. The importance of finance policies and procedures cannot be overstated in maintaining the integrity and accountability of an organization's financial processes. These policies serve to safeguard against theft, embezzlement, and other forms of financial misuse, while also ensuring compliance with laws and regulations. To promote staff compliance, it is essential to keep policies simple and easy to understand. Involving subject matter experts in policy development ensures accuracy and relevance, while scheduling regular policy reviews helps to keep them up to date and aligned with the organization's evolving needs. Thank you all for viewing this e-learning module. Have a wonderful day.